I want to talk some more about this. Drew Kanaly is chairman of Kanaly Trust Company. Joins us now from Houston. Drew, good of you to join us. When you watched all the various moves that we documented on our charts here a couple of moments ago, what went through your mind today?
Well, what went through my mind is what's really going on here is the P&P was saying that they didn't get the valuations they wanted out of 3 funds. Okay, this was within hedge funds that the bank manages. This wasn't a banking side issue. This was a hedge fund issue. So they didn't get the bids they like, so they just said, we're not going to allow any withdrawals right now until we get the prices we like. So at this point, I mean, it's just a valuation issue. Think of it like this. You put your house on the market, and you didn't get the prices you want for your offering. So is your house worth 0 all of a sudden? That's more closely what's going on here.
This whole volatility issue, though, that seems to be pervading the markets right now. We had the drops of last week. We had the 3-day rally. Then we had this, jumping off the side of the cliff thing going on today, it seems. Talk to me about that.
Okay, so we walk up to a pool, and we can't see the bottom. Okay, I say it's 4 feet deep, and the fellow next to me says it's 400 feet deep. Now, we can't see the bottom, and neither one of us have any real data points to say how deep it is. But because of just unknown fears, without any real data points, the market is assuming it's 400 feet deep. But we really do have information that tells us it's only 4 feet deep. We know that earnings were better than expected again. What? North of 9% for the second quarter in the S&P 500. We know that unemployment is still 4.6%. They're not giving these jobs away for charity. They're actually employing these people. And GDP just reported was 3.4. We've got those data points. We don't have data points on how deep this pool is in what is being assumed to be a credit crisis.
So if I read you correctly here, what we're talking about is just, it's a fear that is out there, and that fear is based on not bad information, not good information, not negative information, but to a certain extent, no information.
Exactly. Markets can discount good news, they can discount bad news, but they can't discount the news they don't know. So they're going to start making some assumptions about it, and they're going to start putting dots out in the future that may not necessarily be true. And there certainly haven't been any dots that have come true so far in this credit crunch, because there's still plenty of credit available. Maybe not at the price you want, but you can go still borrow money today, right now. You can call up your bank and they're going to lend you money.
All right, so what do you do in the meantime?
Well, in the meantime, you look at it and you say to yourself, okay, what's going on here? They're repricing everything. They're repricing risk. Lending institutions, I called the other day for a client, just a conforming loan, very simple deal. They said you can have any maturity you want on the mortgage as long as it's 6.375. So that's the bank just pulling back saying, wait a minute, I want to see what's going on. It's not panic time. In your portfolios, you certainly shouldn't be selling. And if anything, you should be looking at this as a buying opportunity.
But do you get a sense at this point that regardless of the logic that you're making right now, that we're going to have a little bit of fear and volatility with us in the foreseeable future?
Yeah, I mean, it's summertime kind of stuff, and it's going to be like this until everybody comes back from vacation and cooler heads prevail, and they get some real data points to show them what's actually going on versus just pure speculation.
All right, Drew, have to leave it there. Appreciate it. Thanks very much.
Mike.
That's Drew Kanaly from the Kanaly Trust Company.